On the evening of December 10th, 2008, Bernie Madoff poured 2 glasses of scotch and sat down with his sons in his Manhattan penthouse. The view from the 64th floor was spectacular, the city lights stretching endlessly below. He looked like a man who had everything. Then he told them the truth. There were no investments. There never were. Every statement, every return, every quarterly report for the last 20 years, all of it was fiction. The $65 billion that thousands of people believed was safely invested was gone. His sons stared at him. Then they picked up the phone and called the FBI. Within 24 hours, the most respected man on Wall Street was in handcuffs, and the largest financial fraud in human history was about to unravel. Bernie Madoff didn't come from money. He grew up in Laurelton, Queens, a modest neighborhood in New York City. His father, Ralph, was a plumber who dabbled in penny stocks and at one point registered as a broker-dealer. Though nothing came of it, his mother briefly ran a small brokerage firm from their home. Both parents failed to file financial reports with the SEC, a detail that, in hindsight, reads like foreshadowing. As a teenager, Bernie worked as a lifeguard at Rockaway Beach, saving $50 here, $100 there. He was good-looking, charismatic, and deeply ambitious. In 1960, with $5,000 he'd saved from lifeguarding and sprinkler installation, and a folding table in his apartment, he started Bernard L. Madoff Investment Securities. He was 22 years old. His timing was perfect. The 60s bull market was just beginning. Madoff was one of the first traders on Wall Street to use computers to match buyers and sellers faster than the traditional stock exchange floor. While other firms still relied on phone calls and handwritten tickets, Madoff's operation was electronic. He wasn't just smart, he was a decade ahead of everyone. By the 1980s, his firm was handling billions in trades. He became chairman of the Nasdaq Stock Exchange, not once, but twice. He sat on the boards of major financial institutions. He dined with senators. He advised the Securities and Exchange Commission on how to modernize market structure. Bernie Madoff wasn't just a Wall Street insider, he was the insider. The man the regulators came to for advice on how markets should work. Nobody thought to ask, what if the advisor himself was the fraud? The scheme was elegant in its simplicity. Madoff promised his clients steady returns of 10 to 12% a year. Not spectacular enough to raise suspicion, but consistently better than the market. Year after year, decade after decade. Rain or shine, bull market or crash. The returns never wavered. In 1994, the year Orange County, California went bankrupt from risky investments, Madoff's clients made money. In 2001, when the dot-com bubble wiped out trillions, Madoff's clients made money. In 2002, when the S&P 500 fell 23%, Madoff's clients made money. The consistency was mathematically impossible, but nobody wanted to do the math. The secret? There was no investment strategy. Not a single trade was ever made with client funds. When new money came in, Madoff used it to pay the returns for existing investors. Classic Ponzi scheme, named after Charles Ponzi, who ran a similar fraud in 1920. But Madoff's version was different. Ponzi's scam lasted 8 months. Madoff's lasted at least 20 years, possibly longer. And the key was exclusivity. You didn't find Madoff. Madoff found you. Getting into his fund felt like joining an elite club. He would actually turn away potential investors, making them desperate to get in. Country clubs in Palm Beach whispered about him, like he was a financial messiah. The feeder funds were the real engine. Firms like Fairfield Greenwich and Tremont Group collected money from wealthy investors worldwide and funneled it directly to Madoff. They earned fat commissions, hundreds of millions in fees. They asked no questions. Billions poured in from Switzerland, London, Abu Dhabi, and Tokyo. By 2008, the web of feeder funds stretched across 4 continents. Here's the part that should keep you up at night. A man named Harry Markopolos figured out the fraud in 1999, 9 years before Madoff was arrested. Markopolos was a financial analyst in Boston. A colleague showed him Madoff's returns and asked him to reverse engineer the strategy. Within 5 minutes, Markopolos knew it was impossible. He ran the numbers. He modeled every legitimate trading strategy that could produce those returns. None of them worked. The math simply did not add up. So Markopolos did what any responsible person would do. He went to the Securities and Exchange Commission, the agency specifically created to catch this kind of fraud. He submitted a detailed report titled, "The World's Largest Hedge Fund is a Fraud." The SEC investigated. They sent junior staff to review Madoff's books. Madoff charmed them. He showed them his legitimate trading operation, the market-making side of his firm, and they went home satisfied. Markopolos submitted a second report, then a third, then a fourth. Over 9 years, he contacted the SEC 5 separate times with increasingly desperate warnings. Each time, they did nothing. He later testified before Congress. "I handed them the case on a silver platter, and they refused to pick it up." He also said he feared for his life, that a fraud this large had to have organized crime connections, and that exposing it could get him killed. For 17 years, Madoff ran his scheme without serious threat. But in September 2008, the global financial crisis changed everything. Lehman Brothers collapsed, the stock market went into freefall, and Madoff's investors, terrified by the chaos, started calling. They wanted their money back. All of it. Now. In November alone, clients requested $7 billion in redemptions. Madoff scrambled. He tried to raise new money to cover the withdrawals, but in the middle of a financial panic, nobody was investing. The Ponzi scheme's fatal weakness had always been simple. It only works as long as more money comes in than goes out. By December, Madoff was $200 million short. The machine that had run flawlessly for 2 decades was grinding to a halt. And Bernie Madoff, the man who had fooled the SEC, the banks, and thousands of the world's smartest investors, knew it was over. That's when he called his sons to the penthouse. The numbers were staggering. 4,800 clients, $36 billion in actual lost money. The rest, the 65 billion headline number, was the phantom profits that Madoff had been printing on fake statements for years. But the real devastation was human. Elie Wiesel, the Nobel Peace Prize winner and Holocaust survivor, lost his entire life savings and his foundation's $15 million endowment. Steven Spielberg's charity lost millions. Mort Zuckerman, the real estate billionaire, lost 500 million. These were the famous names. The ones you don't hear about are worse. Retirees who had trusted Madoff with everything woke up to discover their life savings were gone. One 70-year-old investor killed himself the day after the arrest. Thierry de la Villehuchet, a French money manager who had funneled his clients' money to Madoff, slit his wrists in his Manhattan office on Christmas Eve. Charities that served the homeless, funded medical research, and supported education shut down overnight. Not because they were poorly managed, but because their endowments had been entrusted to the most trusted man on Wall Street. On March 12, 2009, Bernie Madoff stood before Judge Denny Chin and pleaded guilty to 11 federal charges. He showed no emotion. His statement was carefully rehearsed. Judge Chin sentenced him to 150 years in prison, the maximum possible. He called the fraud extraordinarily evil. Madoff was 71 years old. He would die in prison. But the punishment didn't stop with Bernie. His brother Peter received 10 years for his role as chief compliance officer. The man supposed to prevent exactly this kind of fraud. 5 other employees were convicted, and then there was Mark Madoff, Bernie's eldest son, the one who had called the FBI that December night. He never recovered from the shame. On December 11th, 2010, exactly 2 years after his father's arrest, Mark hanged himself in his apartment while his 2-year-old son slept in the next room. A court-appointed trustee named Irving Picard spent over a decade clawing back $14.7 billion, a recovery rate of nearly 70%. Extraordinary for a fraud of this scale. He sued banks, feeder funds, and even victims who had unknowingly withdrawn more than they'd deposited. The question everyone asks is, how? How did one man fool the entire financial system for 20 years? The answer is uncomfortable. He didn't just fool the system let him. The SEC had 5 separate warnings and did nothing. The major banks that served as Madoff's custodians never verified his trades. JP Morgan Chase, which held Madoff's primary bank account, filed a suspicious activity report with British authorities in 2008, but never filed one in the United States. After the scandal broke, JP Morgan paid $1.7 billion in penalties. But no individual banker went to prison. No SEC official was fired. The Madoff scandal led to the Dodd-Frank Act, new whistleblower protections, and reforms at the SEC. But the fundamental problem remains. Financial regulators are underfunded, understaffed, and culturally deferential to the industry they're supposed to police. Harry Markopolos put it bluntly, the SEC is a 100-pound chihuahua trying to regulate a 2,000-pound Great Dane. Bernie Madoff died in federal prison on April 14th, 2021. He was 82 years old. He had served 12 years of his 150-year sentence. He died of kidney failure, alone, in a prison hospital in Butner, North Carolina. Not a single family member claimed his body. His wife, Ruth, who had lived in a $12 million penthouse on the Upper East Side, was eventually allowed to keep $2.5 million under a deal with prosecutors. She moved to a small apartment in Connecticut. Both of her sons were gone. Her husband died in a cell. The family name became a synonym for betrayal. In a prison interview years earlier, Madoff said something that should chill every investor. People ask me all the time, how did I do it? And I told them, it was easy. They wanted to believe. That's the real lesson of Madoff. Not that one man was exceptionally criminal, but that thousands of smart, sophisticated people chose not to look too closely at returns that were too good to be true. The banks didn't check. The regulators didn't investigate. The investors didn't question. Everyone wanted to believe. The next Madoff isn't hiding in the shadows. He's sitting in a corner office right now, producing steady returns, charming regulators, and relying on the one thing that never changes about human nature: our desperate, irrational need to trust the people who tell us what we want to hear. Subscribe to Compounding Crow, because understanding how money works is the first step to making it work for you.